All right. So here we are with Do Kwon. Do, welcome to the Defiant podcast. Really excited for this conversation.
Yeah, thanks for having me on the show.
Of course. So, Do is a co-founder of Terra, and Terra is a really interesting ecosystem of different blockchain applications, including the Terra stablecoin, the Luna token, the Anchor lending platform, the Mirror platform for trading synthetic stocks and digital assets. So there's a lot going on with Terra. There's also millions of actual users, which is a lot more than most DeFi and just crypto applications can say. So really curious to hear your story on how you got here. But let's start with the beginning. I'd love to just learn more about you and your background and what got you into crypto.
Yeah, so when I first graduated from computer science, I'm a software engineer by training. I joined Microsoft as an engineer, and a lot of the work that I was doing was in NLP. So like when I first joined, maybe it was just like the department that I got placed in, but our team had 34 engineers. And there were, I think, at any given time, just like maybe 3 or 4 people doing work. It was just like not a very ambitious environment for, like a young, aspiring engineer to be able to do lots of work. So I used to, started to tinker with side projects until I made a prototype for something that got me excited enough to, to quit and to make a startup. So what that technology did was that it was in Wi-Fi mesh. So it allowed user devices like cell phones and laptops to connect to each other via Wi-Fi, direct or Bluetooth. And the idea was that even if you don't have direct internet access, like connection to a cell tower or a Wi-Fi router, you could connect to the internet through a network of other people around you. So it was sort of like a distributed network of human beings in densely populated or poor internet connection areas. Yeah, so we turned that into a sort of a B2B business, targeting large enterprises like airports and amusement parks and things like that. And then you can imagine that the standard Google search query for distributed network turns up a lot of things like Bitcoin and Ethereum. And then that's sort of how I got started to get acclimated to crypto. And I think sort of a turning moment for me was when one of my friends invited me to a Facebook chat group with 8 people. And then it was mainly, friends from college that were talking about things like Bitcoin and Ethereum and different things like that. And then that conversation actually turned out to be a lot more intelligent than the stuff you find on Reddit. So that's when I got hooked and then started to spend more time looking at white papers and go to meetups and participating in community chats until, in 2017, I decided to quit my company and then to do something in crypto full time.
And so when you decided to quit your company, this is the distributed network, like Wi-Fi solution that you started, right?
Right.
Okay. And then what was the first thing that you did in crypto full time?
Yeah. So actually, I quit my job in Halloween of 2017. And then that day, I went out for drinks with one of my friends who was running like a small fund of sorts at the time. And then he invited another friend. And then that friend turned out to be the co-founder of Terra, Daniel Shin. And then, like at the bar that day, we started to talk about, like he was like looking to buy QTUM, which was, I don't know if you remember QTUM, but it was like the basic premise was that you combine the best of Bitcoin and Ethereum. And then, like the webpage didn't really scale correctly and it was worth like $6 billion or something. And then I asked him, do you really want to invest in something that can't put together a website without typos or scaling correctly? And then that led to an interesting conversation about like what it would take to get a cryptocurrency that has lots and lots of real users. So that adoption conversation led to stablecoins and led to what is Terra today.
That's so interesting because back in 2017, there weren't many stablecoins. Like, obviously, right now, stablecoins are super popular. Everyone uses them for trading. But in 2017, it was Tether, right? And I don't know, like if there were that many others. Like obviously, DAI wasn't around. USDC wasn't around, I don't think.
Right.
So that's interesting. I mean, what kind of made you think of stablecoins as like the mainstream use case?
Yeah. So I mean, there were a couple of different reasons, but when most people that were doing something in, let's say, digital commerce looked at Bitcoin for the first time, like the main roadblock to getting Bitcoin adopted wasn't so much, speed or scalability. It was, volatility, right? So Bitcoin has upside, yes, but in a marginal business, like let's say an e-commerce company or any company that sells goods and services across the internet, it's actually cost prohibitive to have that volatility built into Bitcoin. And Tesla can afford it because it's Tesla. But for most companies, it's really hard to run the risk of your proceeds dropping significantly in price, because that volatility can make it difficult to meet, let's say, payroll or to pay distributors in a timely fashion. So from a business perspective, volatility was one of the greatest roadblocks to adopting cryptocurrencies. There's obviously different things like custody, wallet management, and different things like that. But like fundamentally, if you couldn't get to a state where you could sort of guarantee crypto holding value stable to some mainstream unit of accounts, then we thought it'd be really hard to get it adopted. So there was this paper called Senior in Shares by this British gentleman called Robert Sams that I read through when I was doing research into crypto. And that actually later inspired a lot of algorithmic stablecoin projects like, let's say, Basecoin, Terra, and I think to some extent MakerDAO, and lots of other ones that came after it. And the idea was that essentially you would sort of have a second coin from the stablecoin absorb all the volatility from the first. And the idea was that there are a set of people that enjoy that volatility for speculative purposes. And by having the second group absorb all the volatility from the first, you can allow the stablecoin to be used as a medium of exchange, store of value, and unit of accounts in day-to-day business.
That's interesting. So obviously that's a model that DAI has with, at first just ETH backing the stablecoin DAI, and absorbing that volatility, as people also use take the other side, right? Right. With Terra, does it work in the same way? Like how does Terra achieve its stability?
Yeah. So in a weird way, MakerDAO is quite similar to Senior in Shares as well. Instead of creating their second currency, they simply use Ether, right? So when the, shall we say, the circulation of DAI is decreasing, right? It's as if Ether that's been locked up is being minted out of CDPs and entering the circulating market through liquidations and margin calls, right? And then when the markets are good and there's more DAI in demand, it's as if more Ether is being burned and locked up into CDP contracts to, so it's like a very similar model where ETH absorbs the volatility of the DAI stablecoin in some sense. So the primary difference between MakerDAO and Terra is that with Maker, it's an over-collateralization model. So given that they use a second larger currency, they don't have the luxury of, let's say, minting Ether whenever they choose to or burning Ether arbitrarily. So what that means is that anytime that you want to create 1 unit of DAI stablecoin, you need to lock up, let's say, $150 worth of ETH, because you want to leave some room for arbitrageurs to be able to, make the system whole whenever you need to liquidate collateral to be able to buy back DAI stablecoins from circulation. So for Terra, it's a different model where the second currency itself is native and something that we've created. So the entire model is that anytime that you want to mint $1 worth of Terra stablecoin, you burn $1 worth of Luna. And then vice versa, if you're looking to redeem $1 worth of Terra USD, the system mints and gives you back $1 worth of Luna. So in that sense, like given that it's a one-to-one pegging between Terra stablecoins and Luna, it's more capital efficient. But of course, like given that it's like an entirely new currency, in sort of black swan situations, you can make the argument that it is more fragile than what you would find in sort of larger crypto-backed counterparts like MakerDAO.
So, like, just like without like studying this very closely or having a degree in economics, just thinking what the risk could be, like, could a large group of people just start trying to since it's just like easier to mint a lot of the stable coin, can somebody just like buy a bunch of Luna and in that way just like mint a bunch of stable coin, and then I don't know, like it seems like because there's no kind of external currency to it, it seems like it's hard. It's easier to game for I don't know. Like how did you go about kind of like reaching some sort of equilibrium where it's expensive to do that? Like when it's expensive to just like come up with a bunch of Luna and try to game the system.
Yeah. So for all these stablecoin systems, the biggest point of risk is when cascading liquidations happen. So if you remember what happened on Black Friday, March of 2020, you had a bunch of DeFi protocols fail at the same time. So you had cascading liquidations where, Maker protocol, for instance, tried to sell all the Ether that it had to be able to buy back DAI. But there were too many transactions that were happening. Transactions were clogged on the mempool. So you had a momentary situation where the Maker protocol was insolvent to, it was like $13 million or something like that. And it's exactly the same mechanism, right? So in a time where you're trying to sell the collateral in order to make the principal whole, right? Similar to how, like, if you're trying to sell a lot of ETH quickly, or let's say like a bunch of margin longs on Binance gets liquidated for BNB, and then it leads to like a 20-30% price drop really quickly, or any similar situation like that. If a lot of people are trying to redeem Terra USD quickly for Luna, then in that case, Luna gets sold off in the market very quickly, and then that leads to sort of a cascading failure where the cost of redemption gets higher and higher, right? So I think the weakness there is that Luna is going to be less liquid, and it's less valuable right now than Ethereum. So, that cost of cascading failures is going to be larger. But the upside, though, is that given that the system doesn't keep any explicit collateral, if arbitrageurs are willing to wait until that cascading liquidations has stopped, then in that case, you can still redeem Terra USD for whatever market value of Luna happens to be at that any given time. Yeah, so, cascading failures could happen if, a lot of stablecoins are being redeemed at the same time. Mm-hmm. But the design of the protocol is that it should eventually be able to recover.
Have you ever had an event like that happen?
No, so we haven't had anything like that. So that's actually like a really interesting point. So one of the things that I thought like a lot of stablecoin designs are missing is that it really, like, at the end of the day, the core stability comes from utility and adoption. And what I mean by this is that the US dollar isn't the most stable because they have the most intricate monetary policy. In fact, it actually so happens that the larger the economy, the less intricate the monetary policy, right? The US dollar is the strongest because it is the most widely used fiat currency in the entire world, right? So taking inspiration from that, I thought if you're gonna be designing a stablecoin and then present it to the wild, and then you're sort of hoping that some people pick it up for this use or another use, then in that case, and it's poorly adopted, then it's going to be very hard to hold the peg. So if you saw like an explosion of algorithmic stablecoins during summer of last year, like every single one of them failed to hold the peg, especially because they weren't able to foster any non-speculative use cases around them. So basically, we thought like a good way to make sure that Terra's economy and its peg becomes robust over time is to create lots of use cases around them that are sticky. So for example, payments. So today, Terra stablecoins are being used by, like 2.6 million people in Korea for, payment transactions. And then it turns out that with payments, like user adoption is fairly sticky. So once you start to get into the habit of, let's say, buying milk or your diapers with like a payment medium, you generally don't switch for long periods of time. So if you're sort of able to raise the demand floor over time by building and diversifying the use cases that are built around the stablecoin, then the stability profile of the currency gets much, much stronger.
And who's taking the other side? Like who's using like the Luna side to it? Like who's actually kind of minting and redeeming these stablecoins?
Well, so it's profitable in lots of different cases for market making firms or trading firms to be doing the swaps. So for example, at any given time, if Terra USD is trading above $1, then there's an arbitrage opportunity for people to buy up $1 worth of Luna, swap it to Terra USD, and then sell it in the market for a premium, and then vice versa for redemptions as well.
Got it.
So we have a number of trading entities and individuals that engage in these types of swaps, and probably many that we don't know about.
Very cool. Okay, so you mentioned that there's millions of people right now using the Terra stablecoins, and that's something that many cryptocurrency projects aspire to, obviously. What do you think you've done to get this right? Like, how did you get this kind of wide user base?
Yeah, so to be completely honest with you, I think in the beginning, when we tried to sell the idea of crypto payments to e-commerce companies, I think most of them didn't get it. So, I think in the beginning, Daniel's sales network really helped because he had built the first and one of the largest e-commerce companies in the country, as well as, like the largest shared office. So WeWork, copycat, that's about to IPO pretty soon. It is now bigger than WeWork in the country. So he was able to sort of get like a lot of the e-commerce founders to agree to adopt the currency. And then when we tried to sell it to their working level, there was very little understanding. But I think now there's a lot more clarity around the business proposition that's getting a lot of merchants to adopt Chai, so the payment service, and then to push it very strongly to their consumers. And the business case is pretty simple. So we, using stablecoin networks to settle has two major benefits. So first, you are able to settle very quickly. So in using traditional payment services, the average settlement timing is about 7 days. So which means that once a user, pays on the e-commerce website for something, the payment gateway would enter a 7-day delay for the money to be transferred to you, which is, prohibitively expensive for a lot of different use cases, right? So for example, if the platform works with lots of freelancers or smaller businesses, then in lots of cases, these smaller businesses need the money right away because they have working capital issues. So like a cab driver, for instance, might need the money right away to be able to put food on their family's dinner table, or to be able to pay for gas for next day rides. And same for like small restaurants and things like that. So by not settling using traditional settlement networks, but to settle to merchants directly in stablecoin, we're able to cut down settlement times from 7 days to 6 seconds, which is the average block time of the Terra blockchain. And what we've also done is that we've sort of added a lot of admin tools such that merchants can get analytics and understanding of how the revenues are coming from, swap out easily out to fiat if they so choose to. So, I think bringing that value proposition to merchants has been very, very valuable. Second thing is, given that we don't use any of the existing settlement networks, we're able to cut down the fees from, I think the market rate is anywhere between 2.7 to 3.3%. We cut that down to 1.5%. So, like in a very tight marginal business like e-commerce, where like if you net marketing, sometimes you're losing money, or sometimes you're running on like 2 to 3% margins. If you're able to save a percentage point, that's a big deal. So, faster settlement times and cheaper fees combined. And when we integrate with the merchant, they have a vested interest to make sure consumers use us instead of credit cards. So they do like promotions and like marketing events to make sure that people switch over.
That's so interesting. And then do they swap the Terra stablecoins for local currency, like for Korean won, or do they keep that?
Oh, so at some point, everyone swaps out to fiat because they needed to pay distributors and stuff. The speed at which people do conversion depends on industry to industry. Mm. So, for example, for industries like fashion, they have a higher tolerance because it's a high margin business and they don't need to swap very frequently. For sort of very high velocity businesses, and they swap very frequently, and that's because one of the main value propositions of this is that you're able to get your money quicker.
Right. So why do you think that, that same kind of like going to market strategy hasn't really picked up that much in the US? To backtrack a little bit, like in Korea, what percentage of merchants are using Chai, would you say?
So it's a very top heavy strategy. So we have about 45 to 50 very large merchants working with us. So for example, like the largest convenience store chain, the largest bookstore, the largest, so it's kind of like a premium brand name acquisition strategy. And then in terms of the long tail, it's not very heavy.
Okay.
Like at 2.5 million, it's about 5% of the population here. So it's, growing fast and fairly decent sizing already.
Yeah. So why do you think the difference is?
Yeah. So
yeah. Go ahead.
Yeah, that's a good question. So I think actually in crypto, if you it's actually the incentives are such that you can build something that's catered towards towards the crypto industry, and that's just going to be a lot more worthwhile than going out into the real world and trying to acquire users. So for an average developer, if you wanted to, I'm guessing that for most people, like the goal is profit maximization. So if you wanted to get rich quickly, it's just much easier to build a small team of people that are trying to, let's say, issue an NFT protocol or a DeFi protocol. And then that's going to have, a decent number of users, like maybe, a few thousand. And then that's just going to be enough to make the developers very wealthy, right? Because of the market. So it just doesn't make sense to go through sort of the hurdle of educating consumers and then building relationships and then doing sales when you could, probably 10x the result with 100 of the effort in a short time.
I think that's a good hypothesis. And maybe it was kind of you started this in 2017, so in the middle of a bull market, but then I guess all of the adoption and building continued through the bear market. Do you think maybe that kind of played a role into why you moved really strongly into outside of crypto, since it wasn't as easy as it is now to make money inside of crypto?
Yeah. So ultimately, I'm one of those people that believe that Wall Street only exists because of Main Street, right? At the end of the day, if you think about what are the key levers that moves the economy, it's the people that are actually producing things with the capital that's been allocated. But if capital is allocated in a vacuum, then it's kind of meaningless, right? That's essentially what a bubble is. So I felt it's not so much that I don't think that the things that are being done inwardly in crypto is valuable. Those are extremely valuable. But I felt like there was nobody that was trying to do things looking outwards into, sort of growing the pie, bringing more users in, and making crypto more approachable for the everyday user. So, somebody had to do the job, and I felt like that was a good place to start as any. It's the jury's still out as to whether that was a good idea, but it's extremely fulfilling because you see, for example, like even outside of payments, if you look at Mirror Protocol, like the thesis is that you can invest into any asset class at once without restrictions or hampering with existing systems. And then like our top markets are Thailand, China, and Indonesia, where the access to US equities is really, really difficult to do. So, and then we're seeing very small ticket sizes come in, like maybe there's like a $50 stock purchase. I've seen even like a $9 purchase, right? So obviously there's something that we're doing to lift barriers to allow, smaller users to come in that are outside of crypto today. And then the value proposition is making their lives better. So it feels good when you see stuff like that.
Yeah, 100% agree. So do you think right now, is DeFi in a bubble in that sense? Like are DeFi protocols making like building inwardly and just making money, like just like this like cycling money system of like yield farming and pump and dumping new tokens and farms? It does feel a little bit like a bubble, to be honest, like this just like inward cycling of capital. What do you think?
Well, but Cami, if you think about it, like in 2017, the problem was that teams were shipping too slowly, right? So you've seen like companies raise like $100 million and then ship nothing 2 years later. But with DeFi, it was sort of like the opposite problem where people weren't raising any money and then shipping too quickly and then things breaking, right? So obviously things are moving for the better in the sense that like, even if you look at private markets, valuations for new DeFi protocols that are coming out are much, much lower. There's no more companies that are raising like $50 million anymore, right? So in some sense, I would say that there is a lot of hype, but I think the fundamentals in DeFi are a lot stronger than what ICOs looked like in 2017. I think it's fine if there's lots of different projects like food coins, like pickle and like French fry or like souffle. These are probably real coins, right? It's fine if these assets, sort of yield farming in a vacuum, because if there's, projects like Mirror and like Anchor and different types of things, bring in users to fill in the base layer, then in that case, the more speculative stuff that gets built out on top just leads to better allocation of capital, right? So I'm just trying to do the former such that the latter doesn't turn into a bubble.
Makes sense. I 100% agree. I mean, this is another world compared to 2017. There's like actual useful projects being built, actual users, even though like it feels like much of it is speculation. I agree that kind of the and like the outcome of all this speculation will be just, better products and bringing in other types of users who are, like hopefully leveraging open finance for the real lives and not just, for flipping some like food coin.
Right.
So, okay. So with this, very large user base and people actually using the Terra stablecoin for payments, how is the Terra blockchain able to support this level of transaction and throughput? Like, how is it built?
Yeah, so Terra is a DPoS consensus mechanism with Luna as the staking token. So we use Tendermint and the Cosmos SDK. So right now, there's a lot of low-hanging fruit in terms of performance optimization that needs to be done in Tendermint Core or the SDK itself. So right now, I would say like sort of the practical throughput that we're seeing is maybe 700 TPS per TPS. But I think with a few optimizations, it can get to a couple thousand. But like and this leads to like an interesting dialogue about Cosmos and how I look at Tendermint in general. But I think actually like the branding of Cosmos as an interoperability solution is not a great one. I think it should actually be branded as a scaling solution. And if you think about it, like if you look at all the different Cosmos zones that are built in the system, they're sort of exactly the same as shards, right? In a sharded blockchain, except that they're branded independently. They run according to a very similar set of rules. They just sort of run local computation that are relevant to that side of the world, right? And then you sort of have IBC as the consensus there, where if things need to be stored to global state, then you sync up using relayers, right? So I think the future of Terra, using this technology, is pretty simple, right? It's essentially going to get to a branded sharded blockchain, where each of the applications that are being built out, like for example, Chai could be its own independent state machine, and then maybe like even within Chai, depending on geographic regions and things like that, that could have its own state machines. And then Mirror Protocol could have its own state, Anchor could have its own state, and wherever it becomes important to sort of settle to the monetary layer, which is to use Terra stablecoins, then in that case, you sync global state to sort of a global Terra hub using IBC. Yeah.
Okay. And so D+ is delegated proof of stake, right?
Yes.
And that's the consensus mechanism of like the Cosmos ecosystem. Is that right?
Yeah. So all Cosmos related projects use a proof of stake consensus mechanism called Tendermint, which is sort of like the core innovation of the Cosmos ecosystem. And I would say that for most intents and purposes, is the first proof of stake mechanism used widely in blockchains.
Right. And then when you like to achieve like the finality, I guess, like when all the transactions are confirmed and they are kind of downloaded to like the layer one, does that happen on the same kind of blockchain that all of the Tendermint blockchains use, or is it like Terra specific?
They're all separate. They're all
separate kind of shards.
Yeah.
Okay.
Well, no, right now they're all separate blockchains, and then the Cosmos vision is that they will sort of tie together all these separate blockchains into, and then have some sort of global hub.
Okay.
Right. And the technology that enables this is called IBC, but I don't think any of the Cosmos blockchains have connected using IBC yet, so they're all sort of independent, running their own thing.
Okay. And the reason why you would want to connect using IBC is because then you can easily transfer assets from like one blockchain to another in this like Cosmos ecosystem?
No, so that's what I mean when I say that is the wrong narrative, right? So,
okay.
So Cosmos is an interoperability solution. I think is valuable, but I think it's far more valuable to think of it as a scaling solution, right? Because if you have sort of branded, logically independent blockchains or independent shards, then in that case, you can sort of separate logic into all these different shards, and then just only keep global state for the really important stuff. Right?
Okay.
And
So in this kind of like blockchain trilemma, that's, famously decentralization, security, and throughput or like performance. It seems like, where do you think Terra is compromising? Like, it seems like it might. Is it decentralization? Like, how many nodes are there in this delegated proof of stake blockchain?
Right now, there's 100.
Okay. Yeah. So do you think that's kind of where you're like compromising on to achieve greater throughput?
Yeah. So I would say there's definitely sacrifice in decentralization, in the sense that it's not so much that it's centralized, but every time where state becomes too much to handle in one set of validators, you need to split it off into different security consensus. right? So in some sense, like in order for the blockchain to scale, we've chosen a design whereby we split off security into local zones or local hubs of security. So in some sense, like as the blockchain is scaling, there's a smaller set of data that the global consensus reaches agreement on.
Okay, so let me see if I understood this. So when the state of the blockchain becomes too big because there's too many transactions, you split up that state, like that information, into separate blockchains, or like into like other nodes. Yeah.
So we haven't done this yet, and right now everything is running on the Terra blockchain.
Okay.
But the eventual goal is that if it gets too crowded, we'll just spin up another blockchain using Tendermint and the Cosmos SDK. And then we'll connect that to the Terra hub using IBC. And, like in some sense, like if you have too many of these sort of smaller local blockchains and they have their own validators, you could lead to a situation where it's less secure than the main blockchain.
Right.
If that makes sense. Yeah.
So that's the risk of doing that, but you haven't had the need to actually do that yet.
Right.
Cool. Okay, and then changing gears a little bit, I wanted to talk about Anchor, to this new lending protocol that you launched recently, last month, right?
Yes.
And everyone should head to our YouTube channel to watch the tutorial we did on Anchor. So we'd love to hear more about this. Like, what's the idea behind Anchor? How is it different to other DeFi lending protocols? And importantly, like the big value prop here was stable yields. So how is it how are you able to offer that?
Yeah. So to talk about the motivation for the project a little bit, I think we're living in an interesting time where interest rates are kept artificially low for political purposes, right? So if you look at like how inflation is changing against most CPI, it's the dollar is losing value to the tune of 2 to 3%. But if you look at more competitive indexes, like for example, the S&P 500 or most real estate indexes, it's losing value to the tune of almost double digits. So we're at a point in time where the average household is not making enough money from savings to justify cost of capital. And so obviously that's not good. So where Anchor wants to get to is the ability to offer an interest rate that is apolitical and unbiased, and really justifies the cost of holding money in a savings account for the average household. How it differs from, sort of day-to-day, more household name DeFi protocols like Aave or Compound is that if you look at, let's say, Aave or Compound, for instance, like the interest rate that you can get on stablecoins fluctuates pretty widely, anywhere between 0% to 12% in a matter of hours. And the reason why it fluctuates is because, the only reason to borrow USDC or stablecoins from these protocols is, demand for leverage on speculation. So when demand for leverage is high, then yield is going to be high. And then when that opportunity diminishes, then yields are going to collapse to zero. So obviously that's not a great savings experience for the user, because when I'm putting money in a savings account, I kind of want to put it there and forget about it. But if I'm not sure if I'm going to get 0% or 3% or 7%, while running technical risk of putting money in a smart contract, then it just doesn't make sense to be able to do it. So Anchor is able to offer a 20% fixed income product for the user. So the idea is that if you deposit Terra USD into Anchor, you're able to earn 20% per annum, and that rate is guaranteed unless the rate is changed by governance. So how this works is whenever you deposit stablecoins into Anchor, a portion of the deposits are facilitated to loan out to users that borrow stablecoin by locking up their POS collateral in a smart contract. And then the protocol puts that POS collateral to work to earn staking yield across multiple different POS chains, and then confers that POS yield to the depositor in the form of yield. So in some sense, like by using cash flow based assets as collateral in Anchor's money market, you're able to get to a state where you have a diversified stream of proof of stake yields coming in from multiple different blockchains, powering a stable yield for the user. So in some sense, it's a lot more robust than what you would see from DeFi yield farming schemes or any other source of yield in blockchains today.
Super interesting. But that depends on proof of stake yields remaining high, right? How can you guarantee that proof of stake yields will remain at 20%?
Also, so to do a little bit of the back of the envelope math, it's it's whatever the average proof of stake yields are times the minimal collateralization ratio. Because like the loans are going to be, let's say, half of whatever outstanding collateral is out there because the system is over collateralized. So, for example, if the average staking yield is, let's say, 12%, and the minimal collateralization ratio is 200%, then the system can technically offer 24% in yields without the system going bankrupt. So, as to whether POS staking yields are going to stay at 10-12% range for the foreseeable future, most blockchains have a fixed monetary policy or fixed token emission, which means that denominated in that POS coin, it's going to yield that fixed number of coins for like a really long period of time. So some of them have an expiration date on the emission, some of them keep going in perpetuity. But given that the monetary policy is fixed, it's going to keep going for some time. I think, though, that as blockchains mature, POS blockchains are going to try to curb down emissions to a level that is more manageable, because like otherwise it's not great and it's too dilutive. But I think that's going to take many years for that to happen. And then when it does, I suspect that anchor rates will have to keep coming down as well. But the point is that it's never going to get to a state where it's lower than inflation, if that makes sense.
Yeah, super interesting. And so which proof of stakes chains are you using for this?
Yeah, so right now, when we first launched last month, we only integrated with Luna. Upcoming chains are ST. So that's the staking derivative for Ether. That we're going to integrate with soon. And then Solana, which is going to be, it's also going to be interesting. And then we're also going to be working on Polkadot and then Cosmos Atom. And a few other ones for which we don't have, solid development timelines for yet. But the goal is to basically encompass most large cap POS coins.
Cool. Okay. So right now it's all kind of staying within the same kind of Terra ecosystem. Like you're using the Luna, like you're using the Terra blockchain as kind of the backend for Anchor to get these proof of stake yields. But when you branch out to other proof of stake blockchains, like you'll have to convert those. I mean, it seems like the process will be a bit more, like there will be more steps involved in Anchor. Like you'll have to convert those other coins, like outside coins, to Terra, and then bring that yield to Anchor users, right?
So that's really interesting that you asked that. We actually have or setting up Anchor contracts in each of the chains. So there's going to be a version of Anchor on Ethereum. There's going to be a version of Binance Smart Chain. There's going to be a version of Solana, and then so on and so forth. And then you would even be able to deposit in other stablecoins. So, for example, you'd be able to deposit in Tether, Circle, even DAI. And then the idea is that once a user deposits Tether, we're going to convert that into UST using Curve. And then that UST is going to be ferried over to the Terra blockchain such that it can be deposited into Anchor. And then same for collateral as well. So it's going to be a blockchain native experience regardless of where you might be playing around with this.
Oh, that's so interesting. And okay, so your idea is to build these like Terra protocols across chains.
Yes.
And so like in that way, like whenever you're using Terra, like if you're on like Ethereum, you don't have to like go somewhere else to use Anchor. You can just use it on Ethereum.
Got it. Yeah, that's the idea. So, I mean, we sort of think about running Terra as like running a very small, micro developing economy.
Okay.
So we sort of think about like the activity that happens using Terra stablecoins outside of the Terra blockchain as sort of foreign exports, right? So the more that our products get used and integrated into places like Ethereum and Binance Smart Chain, then it's good for the economy. And it actually turns out that stablecoins, once they cross over into a different ecosystem, they don't often come back. So in some sense, in terms of guaranteeing stability of the overall ecosystem, it's even better than sort of things that are happening in-house on the Terra blockchain. So that's an interesting observation.
Will you do the same with Mirror, like build on different blockchains?
Oh yeah, so Mirror is actually already on Uniswap on Ethereum and PancakeSwap on Binance Smart Chain. And I don't know if this is still true now, but when like maybe just even about a month ago, like Mirror pools with UST were some of the most liquid on PancakeSwap. It's probably changed at this point, but it was that was kind of interesting to see.
Oh, cool. Okay, and can you talk more about the and you touched on this already, but on the motivation behind Mirror?
Yeah. So so I when I first started thinking about Mirror, I think it was about September of last year, and then it was right after DeFi summer, and some of that was still going on. But I thought it was kind of really funny how all the coins were naming themselves after coins. And then I saw like rug pull after rug pull, and then it was kind of like, it was entertaining, but I saw a real opportunity to be able to build DeFi primitives that have value tied to real things, right? So, and that's pretty much what Mirror tries to do. So Mirror is basically a synthetics protocol where you can issue tokens that track the price of anything, right? So it could be, Tesla stock, Apple stock, even GameStop or Coinbase is going to be listing on Mirror like within a few days. But basically the idea is that you're going to have coins that track the price of, every asset in the real world. And then I was thinking that for, let's say, like a derivatives platform, a DeFi platform that's freshly launching, it would make sense to get people that are holding mirrored assets of US equities and then sort of airdropping governance tokens to people that do this. So if you sort of had assets with real world value with much lower risk of impermanent loss, this would be very attractive tools that DeFi developers can build on to create sort of things with more tangible value, if that makes sense. And then it turns out that like from sort of like a very basic use case, there's lots of places in the world where they don't have quality access to US equities. So US companies lead the world in terms of innovation, but and it stands to reason that their assets are very highly desirable. But there are lots of places where you can't get good access to US equities, or even in cases when you do, local adversarial regulations make it very difficult for you to be able to access it fairly. So, for example, in Korea and Japan, capital gains tax on single stock on US equities is 26%, whereas on domestic equities is 0.3%. And every time that demand for US equities goes up, the financial regulator issues a statement saying, hey, look, we're considering hiking up taxes again, right? So it's fundamentally designed to prevent capital flight and to keep money as in domestic equity exchanges as much as possible. So as I alluded to previously, what's been really interesting is that we launched Mirror Protocol on Twitter, and we've done no localization to other languages besides English and have done no marketing efforts whatsoever. But like the highest levels of pickup that we've seen is in markets like Thailand and China and Indonesia, where access to US equities is fragmented and difficult. So, I mean, we've sort of been, very surprised ourselves at the level of organic pickup play out in markets where we thought it would have the strongest theses. So that's been very interesting to see.
Yeah, no, I love that. I love the idea behind Mirror, just like enabling access to US stocks for everyone. I think people in the US kind of like assume that everyone can buy Tesla stock, but that's obviously not the case.
Right.
How is this peg actually achieved? Like, do you have to hold actual Tesla stock and issue like synthetic assets against it? Like, how does it technically work?
Yeah, there's no centralized counterparty. So this is kind of like an inverse version of MakerDAO. So if you look at MakerDAO, you have collateral that's posted in ETH, and then a stable synthetic that's issued. So that's the DAI stablecoin. In the mirror system, it's kind of the opposite. So you have a stable collateral, which is Terra USD stablecoin, and then you issue several different volatile synthetics like M Apple or M Tesla or MIAU. So basically, you have a pool of stable coin collateral that's guaranteeing the principal for these volatile synthetics. And whenever the price of these stocks go up too high, then in that case, the stablecoin collateral is liquidated to be able to buy back these synthetic assets.
Got it. And then the price is kept via an oracle, I guess, that talks to like the actual price of the stocks.
Right.
Okay. Okay. So interesting. And we're running out of time. I just had a lot of questions to ask you. So on Mirror, how has adoption been so far? Like and also how is it different from like something like synthetics, which was kind of the original synthetic protocol?
Yeah. So to talk about sort of the pickup first, we're seeing about 20,000 to 22,000 daily active users on the Mirror web app. On the Mirror mobile app, we don't run that service, but should have to check. But also, like, growth there has been pretty interesting. There's about $2 billion in TL locked up across Uniswap, TerraSwap on Terra, and then PancakeSwap. So across all these three different exchanges, we're seeing anywhere between $50 to $100 million in daily trading volume happen on mirrored assets, and it's picking up at a pretty fast pace over time. So all of that has been pretty interesting. In terms of like the difference between synthetics is if you look at Mirror, it's a very simple value proposition. So the idea is that you buy mirrored assets and you hold them, and then you can exit whenever the price of mirrored assets goes up. So in terms of buying and selling these assets, like the mathematics are pretty simple. You hold equities, they go up in value, you exit, you've made that money. With synthetics, there's a couple of points where things are made a little bit difficult. So they use a scheme whereby users have to first mint SUSD and then use SUSD to be able to trade these various different synthetics. And then they have this idea of infinite liquidity, which means that you can swap SUSD to any synth without paying like a large spread. There's maybe like a fixed 0.1% or 0.25% in terms of fees. But the problem there is whenever you're looking to exit, you're not actually trading against the stock market. So if Apple goes up 20%, you haven't made 20%. You're actually trading against other synthetics traders in the ecosystem. So, if all the stock prices start to rally and then you haven't, traded correctly, and then everybody else sort of trades well, and then they've sort of made a similar set of trades, you could end up in a situation where you actually don't make that much money, even if the stock market rallied significantly. So that's sort of like the trade-off that you make with Mirror. You have to have explicit liquidity. You need to put LP into Uniswap and TerraSwap and PancakeSwap, and then that liquidity is bounded, right? So if the trades are too large for the liquidity to handle, then costs are going to go up a lot. On the other hand, with synthetics, they have infinite liquidity, so you'd be able to make 100 million trade without suffering significant slippage. But the cost to this is that you're trading against other traders. So your sort of return profile is going to be a little bit more complicated than what you would see in sort of the more vanilla DEX, if that makes sense.
Got it. And then for that liquidity, I mean, to incentivize that liquidity, are liquidity providers backing these synthetic assets on Mirror? They're gaining, I guess, like trading fees on like people buying the synthetic assets.
Right. So I think on PancakeSwap, these might be a little bit lower, but the liquidity providers make 0.3% on every trade, as well as there's a liquidity mining program going on with the MIR governance token at the moment, so which is also pretty attractive.
Okay, cool. Okay, and then to wrap up, I know we're running out of time. I want to just get your, I mean, there's a lot going on in the ecosystem, and like so many different interesting protocols in the Terra blockchain. But what's your like bigger vision with like how do all these pieces fit together? Like, and where does Terra fit in just the broader DeFi?
Yeah. So if we run over time and you have to cut something, it's probably not the portion that you should cut. So The way that I think about it is that all the layer ones sort of play in sort of the cloud or the computation category. And the idea is that if a lot of people use this distributed computer, then the underlying token is going to grow in value as sort of like a commodity to be able to pay for bandwidth on this computer. So Terra is a little bit different. So we do have an execution layer. We do have lots of different apps that are coming out, but we're not in the business, or we're not in the game of, thinking about ourselves as sort of, like the fastest execution engine, or, like the best distributed computer. Our main products, and we stress this very hard at the firm, our only product is the money that we've created, which is the Terra stablecoin. And all the different products that we've created on top of it, like Chai, Mirror, like Anchor, are simply features to make this money more useful. So the idea is that as we have a savings protocol that make Terra stablecoins more attractive to hold, we have Mirror that makes Terra stablecoins the primary gateway to be able to invest. We have Chai that make our stablecoins easier to pay, and lots of different protocols that are happening. The Terra stablecoin is going to be fundamentally more useful to use than either the US dollar or DAI or any other stablecoin that might come after it. And the great thing about this is, as Terra stablecoins get more widely used, there's a linear relationship in terms of how the Luna token grows in value. So it's not so much that, lots of Terra is minted, so Luna's going to moon or anything like that. But having like a coin that, having an asset capture value in a very succinct way in the growth of a stablecoin, I think is one of the great ways to rally a community around it, right? And these community members, like once they're incentivized through this sort of common value accrual mechanism, sort of roll up their sleeves and go out and build something. So what's been really interesting is that the first generation of Terra protocols has been mainly built by me and Terraform Labs. But the second generation, and I think a lot of these might be even better than the first, are being built by community members that sort of just stumbled across the protocol in some way and got really excited by it. So that's been humbling to see.
Very cool. Okay, so I guess like the bigger vision is to make the Terra stablecoin a more useful currency than even the US dollar.
Right.
Very cool. Awesome. And then just finally, your vision for DeFi or Web3. Is it taking over everything? Is it sharing the spotlight with TradFi? What do you think?
Yeah, I mean, I think, I think the distinction between TradFi and DeFi might be thinner than most people think. So for example, I think I sit in sort of like the intersection of both of these things a little bit. Like, for example, my payment services are definitely TradFi, right? Like a lot of the DeFi protocols that I've created are very, very DeFi. But I think the holy grail is interesting things that happen when these two things sort of start to interplay with each other. And at the intersection, there could be really interesting things. So for example, if we had like anchor yield enabled across, fintech apps, like for example, Chai, or let's say Venmo, how amazing would that be, right? Like all you need to do is in your favorite app that you use to send money to your friends, your money while sitting idle is earning 20% yield. So that's amazing. And like on Robinhood, actually Robinhood is like a bad example, but like imagine a world where like something that looks like Robinhood and doesn't have censorship possibilities is propagated to everyone in the world, even if you're not in the United States. And anybody, be they in Malaysia or let's say Vietnam, could get easy access to buy things like Tesla and Apple whenever they wanted. So I think the vision is like you should have sort of like an acquisition funnel, like very large acquisition funnel of TradeFi powerhouses that are drawing users into very basic use cases of DeFi, like savings and synthetics and different things like that. And then there's always going to be a more sophisticated version of DeFi. And this would be sort of our version of Wall Street, where people play around with perpetual swaps and, sort of novel financial instruments. And I think in both of these different areas of DeFi, there's going to be tremendous growth. And I think it's going to be more symbiotic than what most people realize.
Super interesting. Awesome. Yeah, I agree with that vision for sure. And it looks like you're obviously positioning yourself very well to be in kind of both sides there. Awesome though. Really, really interesting conversation. Thank you so much for your time. It was great.
Yeah, thank you so much for having me.